What is risk measure? Risk measure are statistical measures that are historical predictors of investment risk and volatility. So, risk measure are also major component in a modern portfolio theory or MPT. So, a standard financial methodology for assessing investment for performance. So, there are 5 principal risk measures including alpha, beta, R squared, standard deviation, and lastly, and the Sharpe ratio.
Good day everyone, my name is Glenjan Simafranca. My topic is all about alpha. What is alpha? Alpha is measure risk relative to the market of the selected benchmark index. For the example, if the S&P 500 was being demand to the benchmark for the particular funds, the activity of the funds would be compared to the experienced by the selected index. If the fund outperformed the benchmark, it is said to have positive alpha. If the funds fall below the performance of the benchmark, it is considered to have the negative alpha. That's all my assigned topic. Thank you.
Beta. Beta measures the volatility or systemic risk of a fund in a comparison to the market or the selected benchmark index. A beta of 1 indicates the fund is expected to move in conjunction with a benchmark. Betas below 1 are considered less volatile than the benchmark, while those over 1 are considered more volatile than the benchmark.
So hello everyone, good evening. My name is Aiko Menilog. So for today, I will discuss the squared of measures. So what is squared of measures, by the way? So squared of measure is this the percentage of an investment movement attributable to movements in its benchmark index. On R squared value represent the correlation between the examined investment and its associated benchmark. For example, an R squared values of 95 would be considered to have a high correlation, while an R squared value of 50 may be considered as low. That's it. Thank you.
Standard deviation. Standard deviation is a measure that is used to quantify the amount of variation or the dispersion of a set of values. A low standard deviation means that the values tend to be close to the mean average of the set, while a high standard deviation means that the values are spread out over a wider range. So example, assume the average male height is 5'9" and the standard variation is 3 inches. Then 68% of all males are between 5'6" and 6 and 5'9" plus or minus 3 inches.
Okay, good day. I'm Kian Fernandez. So my topic is all about Sharpe ratio. Sharpe ratio is measures performed as adjusted by the associated risks. This is done by removing the rate of return on risk-free investment, such as treasury bond from experience rate of return. This is divided by associated investment standards deviation and serves as an indicator of whether an investment's return is due towards investing or due the assumption of excess risk. So the importance of Sharpe ratio is mutual funds. It plays a significant role in generating returns and recognizing risk. It helps investors to identify the risk level and adjust return rate of all mutual funds. This gives clear pictures to the investors to know if the risk they can take is giving good returns or not. So, and ang Sharpe ratio is usa sa kasagaran gigamit nga konsepto sa financial nga makatabang sa mga investors nga masabtan ang mga pagbalik sa mga risk-adjusted returns. Kini sa ka measures nga nagpakita nga makuha ganing kanang balik kung na mawala nga kwarta sa ilang gi-invest, like murag way tumong ba. So how does Sharpe ratio work? Ang mga investors nandiyan na goal sa ilang kwarta nga i-invest kay lain pud ni share ka nga maka-goal ana. So ang unang goal nila is gusto nila pero makuha ang taas nga pagbalik sa ilang mga na-invest. Ikadawa, ilang gusto kay maminusan gani sa ilang pag-invest, which is just other ways of saving. They want to lowest possible chance of losing money. Bisag ako guro yung di ko ganahan ma-thank you ra ko bata nga akong invest og shares para sa ka business. Gusto sa jud ko magulang po successful ako sa ka company kay para po sa akong kwarta nga gi-invest dili ra sayang tanan ba. So that will be all. Thank you once again.
What are ways to minimize risk with stocks? Ways to minimize risk when investing in stock is to do thorough research before picking a stock. As an investor, no, it is very important to research the background of that stock, if especially the data. If kung investor ka na dili ka ganahan na kanang let's just say you will lose the value of your money, is kanang you will look for the data, no, kung unsa ka grabe ni taas ang value sa ilang stock in that certain year, and also kung ni decrease ba, and unsay problema nganong na decrease ang ilahang stock. It is very important, no, so that dili ka malugi, or the value of your investment will not lose. Also, diversifying one's portfolio, investing alongside one's risk appetite is also very important. Having a long-term investing horizon. Also, not panicking in terms of volatility, and also regularly evaluating your portfolio. What are risks with stocks? The primary risk with the stock is that you will lose the money that you're invested in. No? The performance of the stock is never been guaranteed. When you buy a stock, there is a possibility that the price of your stock will never increase, and also there's also risk that the price of the stock that you buy is let's just say it will drop, causing you to lose the value of the money that you invested.
Good day, ma'am. My name is Karime Ibacola from BSHM2-POSEIDON. So for today, I'm going to tackle about what is risk reduction. So what is risk reduction, by the way? So risk reduction deals with the mitigating potential losses by reducing the likelihood and severity of a possible loss. For example, an investor with a risk reduction approach to the same oil stocks would diversify their portfolio by keeping their oil stock while buying stock in other industries that could help offset any losses from the oil equities.
Hi ma'am, my name is G. Francis Ortigosa from BSHM2-POSEIDON. My topic for today about pros of risk reduction. Preservation of capital by reducing risk. Investors can protect their capital from significant losses. serving the overall value of their investment portfolio. Second, stability and consistency. Risk reduction strategies contribute to a more stable and consistent performance, which is crucial for long-term financial goals. Third, increase confidence. Implementing risk reduction measure can boost investor confidence in their financial decision, leading to better peace of mind. Better risk return profile. Management and reducing risk can result in a more favorable risk return profile, optimizing return for a given level of risk. Disadvantage highlight the importance of implementing risk reduction strategies to safeguard investment, achieve stability, and ensure overall financial outcomes. That's all.